Warning, this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. For anyone that's new, on the weekend we like to come back and re-examine the base case hypothesis of the channel and check in on it just to see if I can still say with a relatively high amount of confidence that things are going more or less according to plan. And of course, if they aren't, if they start to invalidate, if I start to have an expectation of A and B shows up, then I want to know about it in the first instance, because as always, it's not about being right or wrong, it's just about having confidence that, largely speaking, I understand what direction the markets are going to move and why, and therefore I can position as a trader accordingly. So at the lows, the hypothesis for the stock market was that everyone was too bearish. We were going to have a sharp and sudden rally to all-time highs. There would be rate cuts around the top. And then this is the key part. We would see a global recession and a bear market for risk assets. Fast forward to today, and I would say that this thing is getting close to me calling it complete. Now, there's a lot of uncertainty at the moment, but I think we are currently operating with one of two possible outcomes here. I think either we are starting to form a distributive top here before moving into a bear market and a global recession, or what I am hoping to see is that CPI this week can actually save this market, that we can finish this correction right about where we are and start to look for one final push to the upside to complete the blow off top idea. Now, I know a lot of people get annoyed with me when I say I think we're going to have a blow off top for about a year and a half, 2 years, and then all of a sudden we get to the top and I have to entertain the idea that we might not have a blow off top. But as I often say, it's not about being right or wrong, it's about staying on the right side of the market. If we're going to have a blow off top, fine. And a lot of people would think that my main plan here is to just pump my fists in the air and say I told you so. But the reality is, if a blow off top is not coming, if a near vertical angle is not going to show up, and instead we're going to have this kind of distributive top like this, just like we saw back here in 2022, then from my perspective as a trader, I really don't think there's any point in trying to say blow off top's coming if in fact the market is in the process of proving us wrong on that. So as I was saying in my videos this week, I'm not quite ready to declare tops here officially, and I'm not quite ready to discount completely the possibility of a third and final blow off top angle. To be clear, here's the first one. Here's the second one, arguably in here. Okay, that was what I was using originally. Maybe this is the second angle before the third. Okay, maybe this is what's coming. Maybe CPI can save us. And don't get me wrong, this is what I would love to see. Largely speaking, because it's the easiest to identify if we start screaming up here, and it's the easiest to sell on a trendline breakdown, and it also gives you a nice area to short the market with a stop just above wherever the high forms. Okay, and if we do get a third angle, typically speaking, when they break down, the minimum target is a touch of the first angle. If we are indeed going to have a global recession and true asset price deflation for a short period, which as I'm going to show you in a minute seems to be the base case for me, then we would even expect this first angle to be broken down as well. So nobody wants that third and final angle more than me, okay? Believe me, nobody wants that, just because it's so much easier to deal with than some kind of chop here, and then we buy a breakout and that breakout fails and gets stopped out, and then we buy a breakout and that fails and stops out, and then boom, okay? Nobody wants that, least of all me. But again, I hope you can understand that as much as I would love to sit here and say, buy the dip, blow off tops come in, and then gamble on the idea that if it occurs, I could sit here and say, I told you so, I'm the greatest of all time. Okay, that is not my job. My job is to stay on the right side of the market without bias. So one more time to be really clear, I think wholly speaking, okay, we rallied significantly off the lows. We can check that off. We got the pauses right, as you're going to see when we get to the rate cuts and pauses and bond market section at the end. We also know that rate cuts are coming right around the top, okay, so again, in line with expectations there. And like I said, the only missing component is this third and final angle. Will it show up out of CPI? That is to be determined. But if it doesn't, if we start to get some kind of triple top or another lower high or some kind of breakdown from here, then I think I'm going to be about as close as I could possibly get to officially calling tops on this idea. And again, wholly speaking, it wouldn't have been too far from reality. It would have simply been right up until the last component, and we just wouldn't have got that third angle. So again, I'm not ready to discount the blow off top angle just yet. The market will have to prove to us on Wednesday or by the end of this week, let's say, whether or not that is still on the table. This whole idea was largely derived from Bitcoin. I was expecting Bitcoin to change its cycle structure this time around. It was a very, very unpopular idea at the lows, and only once we broke the all-time high before the halving as expected Did people start to entertain this was a possibility? We did manage to call this pretty well right up to about here. And then since then, of course, we have spent way longer than expected trading sideways. So once again, similarly to the stock market, we have had this 1, 2, we've done something like this into this 2 perhaps. And the only missing component is that near vertical third and final angle. Now, will it show up or not? That is to be determined. Again, the market will have to prove this to us. But as Tony the Bull points out here, largely speaking, okay, we haven't deviated away from it too far. We have so far completed something like this. And now the question is, are we about to break down? Are we about to cancel this fifth of the fifth wave to the upside? Are we about to invalidate that third angle? Or similarly for the stock market, are we going to get saved on Wednesday by CPI data? Is there going to be one final hurrah to the upside? And can we see a third and final angle come in for Bitcoin? Again, there's no way of knowing, okay? The market is going to have to prove this to me. I see a lot of accounts out there still pumping their fists in the air and saying blow off top is coming, right? I see a lot of bears very, very sure of themselves. But the reality is there's no way of knowing. The market needs to prove that to us. It's been half right. You know, we got the all-time high before the halving. And like I said, the only missing component here is that third and final angle or that fifth wave in the Elliott wave system. We have printed extreme fear. We're now sub 22 as of yesterday. This entire bull run, any reading about 33 or below signified local bottoms, cycle lows, and further upside to come for Bitcoin. So will this time be different? That is to be determined. And I noticed Bob Lucas is out here suggesting that we may have just found a day 63 cycle low and be looking for a push. Similarly to what I've just been saying, Bob is also pointing out here that it becomes more of a question of what happens intermediate term after a good bounce. So a cycle low should be in, we should get some kind of push to here, or maybe slightly higher. And then the question becomes, can we have a chance at pushing up towards that all-time high range and breaking? Or is Bitcoin going to continue to do what it's been doing and print lower highs as well as lower lows the entire way down? Now, this is the first change in structure so far. This is currently a higher low relative to this wick, but for this to be confirmed as a change in behavior or a change in market structure, we will need to see Bitcoin's price trade above this local high here. And the risk here is that any counter trend bounce here would indeed be a counter trend bounce that ultimately resolves lower to another cycle low around the first or second week of November. So there is a lot of uncertainty at the moment. The markets and market participants really dislike uncertainty. I understand they're frustrating times, but again, if we can take the emotion out and just let the charts prove to us what's going to happen, then we can still stay on the right side of the markets. If indeed we have got a final hurrah or some kind of top in structure about to show up before a recession, the question for me becomes, since the majority of the market participants believe we can print our way out of this, just like we did in the C19 plunge and a few other times before that, can we see the printer return to save this market, or are we going to enter one of these lost decades? So you can see here, this was 14 years, this was 14 years, 16 and 16 years, and each one of those we saw oscillator resets during that entire decade and a half-ish length of time of stagnation and consolidation in the stock market. Notice how we so far are putting in a very similar oscillator reset, which to me begs the question, if indeed we do see a top come in this year for the stock market, does that top remain the top for up to a decade or so thereafter? Of course, things can change. This oscillator could curl back up. Okay, we could get a bullish cross and we could indeed not see a lost decade. But in the much more short to medium term, okay, the first half of this is more or less complete. Okay, we did indeed see a big strong rally to all-time highs right when everyone thought it was impossible at the lows. We are expecting to see rate cuts at September the 18th FOMC meeting. That usually marks the top within a couple of months, as I'm going to show you a bit later on. And therefore, the second half of this idea, this hypothesis, was that we are going to enter a global recession. And I can see in the comment section, a lot of people are frustrated because people have been, frankly, calling for recessions non-stop for close to a decade now, okay? And we just haven't had one, barring that Black Swan C19 type event. But I simply ask you be open to the data I'm about to present. Please don't tar me with the recession doom posters brush. Unlike most of those recession callers, I have been consistently long, consistently bullish, and consistently calling for blow-off tops to new all-time highs across the board. I was even calling for a Bitcoin all-time high before the halving, and the entire time I have been expecting a recession to show up around this time of 2024. Like I said, I am not one of those doom posters and naysayers that has been bearish the entire way up. I have been publicly long, publicly trading in and out of this thing the entire way. So all I can really do is say I had an idea, and if we are going to see some tops come in soon, then there's no reason for me to walk away from the second half of this idea, which is that we will get a global recession and even a short period of asset price deflation. And of course, if we're going to see a recession show up in the not too distant future, we would expect to see labour market deterioration. So I've been calling for this to accelerate into the end of 2024. And here we are, okay? Initial jobless claims not looking so bad so far, but did we notice this week we had major private sector job misses, okay? So we continue to see the overall trend in unemployment and the jobs data deteriorate. Not to mention the Fed is up to some funny business here because it continues to quietly revise the jobs down. The previous month's data was once again revised lower by 11,000 jobs. So the question is, what is happening with the labour market? And the question I keep asking myself and my viewers rhetorically is, why is it that they keep having to quietly revise the data down? Why is it they can't just openly and honestly present the data? And I have been speculating the answer is they don't want to alarm people and let the majority of market participants understand that a recession is likely coming. We also on Friday got non-farm payrolls come out at 142k, missing estimates by about 22,000. Whilst that number was above the prior readout, okay, the key part of the non-farm payroll data is it is a cross below about 100k that typically signals recessions. Here is that visualized for you. Okay, 100k is this red line across the middle, and you can see every time that non-farm payroll crossed below that 100k level, we entered recessions shortly thereafter. We've also got the real-time SAM rule recession indicator at the hard right edge, okay, showing familiar symptoms of seeing the onset of recessions. We've also got Professor Sam out here performing damage control and saying this time is different and this time doesn't count. To anyone that wants to believe that, of course, you do you. But if you want to know why I personally don't believe her, you only need to look up her previous career history on the Wikipedia page, and you will see why my paranoid mind chooses to ignore the damage control that Professor Sam has been attempting here pertaining to the SAM recession rule triggering. Furthermore, we also have the Conference Board jobs plentiful minus hard to get. This is where we survey consumer confidence and we ask them, do you, in your experience, find jobs plentiful and easy to get or sparse and hard to get? And the more of them that answer hard to get, the higher up this metric will go. The key part here is you can see the orange moving strongly to the upside, along with the unemployment rate in white, which is also curling up. And again, every other time we saw this in history, it led to recessions shortly thereafter. So to summarize, like I was saying earlier, if we were going to have this top and a rollover and a breakdown, we would expect that to be catalyzed by a global recession. If, of course, we're going to have a global recession, we would expect one of those components that would need to be there would be labour market deterioration. And when we take a look at this as the snapshot, okay, job openings looking very, very, very concerning for those people that want to avoid a recession. Rollovers previously led to recessions. The job openings rate of change, okay, similar deal, turns down rapidly into recessions. And at the current hard right edge, we have an even sharper rate of change, telling me at least to be open again to seeing a recession form in the not too distant future. We also have the non-farm payrolls, as I showed you earlier on, ready to cross down towards that magical 100k level, synonymous with recessions, and the unemployment rate continues to curl up despite the short-term wobbles. For example, people are very quick to say, there you go, unemployment's not so bad. 4.2 wasn't as bad as the previous at 4.3, but remember just how markets don't move up and down in straight lines, okay? They have counter-trend wobbles on the way to the primary trend. The same is true in macro data sets. We can have short-term wobbles in the data, but the overall trend seems to be moving towards recessionary tendencies. Another major component of this idea is that we are swinging from a highly inflationary towards a deflationary environment. I have been long making the case that the majority of market participants are offside about inflation. I believe the majority of market participants think that we are about to track the 1970s inflation cycle, meaning that we are close to seeing inflation continue to be perceived as sticky before then entering a new upward cycle for inflation. However, I have been continuously making the case that this is not actually sticky inflation and is a short-term wobble before ultimately the resumption of disinflation. I've also been making the case that as the labour market continues to deteriorate, as the bond market continues to signal recessions are coming, and as investors work out that inflation is not actually sticky and the Fed is very, very late to cut, it is well behind the curve of inflation, we will enter a sell-off in the stock market, a bear market, and that excessive sell-off will drive a bid into the dollar, culminating in a short period of asset price deflation. So whilst everyone has been looking right beneath their noses at the short-term inflation data and saying it's sticky, we have been looking out into the future and using things like the TMC Global Credit Impulse, which typically leads CPI by 18 months, has been telling us to expect continuation of disinflation before ultimately a short period of asset price deflation. This has enabled us to continuously, successfully call inflation to be lower. And one of the largest key components of this inflation is not sticky cool, is that anything you do to the M2 rate of change shows up in the CPI print with about an 18 to 19 month lag. So the perceived sticky inflation that the majority of market participants believe we're experiencing, I have been arguing is in fact this short-term wobble that has shown up here with a lag. So we saw this first leg down, the short-term wobble, and continuation of a third leg down in the M2 rate of change. That third and final leg down is actually missing. So far, the CPI has seen the first leg down, that short-term wobble, and I have been making the argument that therefore this final leg down in inflation is the missing component. So this Wednesday, we're going to find out if this is true. If this is true, if this is accurate, then on Wednesday, we should for the first time see the first true drop in the CPI data. I think we should be somewhere in the mid-twos perhaps. And if we can get down there, the market is going to realize that, like I said, not only is inflation not sticky, but the Fed is too late to cut. It is already well behind the curve of taming inflation. This will also tell us that policy has been too tight for too long. And whilst investors disagree with this, wholly speaking, whilst they don't expect inflation to continue to come off because they think inflation is actually sticky, we've been coining the term tell that to the bond market because the bond market never believed this for 1 second, okay? The US 2-year yield in green, and more importantly, the bond market in aggregate, is actually in charge of forcing the Fed to cut. The Fed doesn't get to choose, the bond market does. And we were saying that the signal for knowing when rate cuts would show up would be when the US 2-year yield started to move lower. That would force the Fed to enter a cutting cycle, just like we saw in all other instances prior. Since then, we know the US 2-year yield has sold off heavily, okay, telling us well ahead of time, well ahead of the curve, that we will be expecting to see the Fed cut. The bond market was actually trying to force the Fed to cut in July's meeting. However, the Fed dug in its heels and said that it did not want to cut. I really don't think it could possibly get out of September's meeting without cutting rates. And there's currently a 70% probability that we're only going to see a 25 basis point cut. Now, I think this is deliberate. I think they're doing this deliberately because they want a bear market, because they want a crash, because they want a deflationary spiral so that they can then print at the bottom of that bear market with a heavily bid dollar and thus maintain dollar dominance whilst exporting the inflation to the rest of the world, rather than print now and risk excessive inflation and a loss of confidence in the dollar. However, with that said, if we do indeed see a colder print as expected at Wednesday's CPI print, it is likely that we will see this significantly reprice towards a 50 basis point cut. The whole idea of rate cuts being bullish or bearish is a point of contention for many investors at the moment. There's a lot of debate about whether or not these cuts will be stimulative for markets or whether these will be the start of a bear market and recession. I have been making the case over and over again that these are not cuts into normalization, okay? When we cut into normalization, that means we are cutting into inflation returning to 2% whilst having a soft landing, whilst avoiding a recession. I have been making the case that that is not what we have at the moment. These are in fact cuts into a slowdown. These are cuts into a deteriorating labor market. These are cuts into weaker and weaker economic data. And if I am right about that, then it is only reasonable to expect the top to come in within about 2 months of the onset of that cutting cycle, just like we saw in all prior instances. This again lines up exactly with what I've been saying about seeing the push to all-time highs, rate cuts somewhere around the top, and then that big bear market and recession. And again, this has not changed since the bear market lows, okay? Do they cut here at the top? Makes perfect sense, because if we are indeed going to see labor market deterioration, if we're going to see the onset of a recession and economic slowdown, then those would not be cuts into normalization. They would in fact be cuts into a slowdown, which is historically very bearish. To put this in perspective, here is the NASDAQ versus the prior rate cuts. Okay, you can see in one case, the red fractal, we actually managed to rally about 22% to the upside before then ultimately putting in a top and entering that bear market and recession. The prior times, we fell up to 56% from the onset of that first rate cut. Speaking to cuts into a slowdown, okay, notice the unemployment rate spiking just like it did in all prior recessions. Notice the economic activity in the US, okay, moving to the downside just like it did in all prior recessions. So once again, I'm here to suggest that these upcoming rate cuts will indeed be cuts into a slowdown rather than cuts into a normalization and thus have bearish connotations. You can see why I cannot quite discount the blow off top here as well, because there is always the possibility there is one final hurrah to the upside to set that third and final angle, as I was talking about at the start of this episode. But equally, we may not get that from the market, and instead we may be putting in one of these more distributive tops before ultimately rolling over again, which is why I have to be open to all possible outcomes here, including not seeing a third angle and instead seeing something more like this. And there is more evidence to support that both a recession is coming and that these cuts will be in fact bearish, because they are cuts into a slowdown, because they are against the backdrop of an inverted yield curve, which is now getting ready to revert above the zero line. In fact, it has reverted back above the zero line. Most of the time we see this, we see recessions shortly thereafter. There's a subtle nuance to this in that most investors get it wrong because once it crosses below, people start calling recessions, okay? They start saying, well, recession will come within 12 months, or they start calling recessions immediately. But the nuance here is it's crossing back above the zero line and then accelerating that gives us the recession trigger, okay? You can see that here, back above the zero line, accelerates, then we get a recession. Back above the zero line, accelerates, then we get a recession. Back above the zero line, accelerates, then we get the recession. To put this in a little bit more perspective here, you can see that here, when we get the yield curve revert and accelerate, there's a little bit of time in which the market could potentially rally. In this case, it did not. Similar deal here. We revert above the zero line, we accelerate to the upside, and there was a little bit of time to see the market put in one final top. This one doesn't quite count as we didn't truly invert, we just bounced off of zero as support, but you can still see a similar concept applies. We accelerate to the upside, there's a last chance for the market to put in one final high before then we get the true acceleration and the onset of that crash, which of course begs the question today, since we are now back above the zero line, at least for the 10-2, have we got a last chance for one final hurrah whilst this thing accelerates to the upside? Therefore, is it possible we do see a third and final angle come in? We get one final push to all-time highs before then the onset of that bear market and global recession. There is nothing easy about these current times. These markets are going to continue to be more and more difficult to navigate. Like I've been saying over and over again, I really hope we get that push, because that is far easier to deal with. It's far easier to sell than these kind of distributive tops where you have to keep buying breakouts and the breakouts kind of fail and stop you out a few times before ultimately we end up selling trendline breakdowns. So I do think we should all be championing a blow off top here, but I'm just not convinced that being 100% sure of yourself that it's coming is the best approach here. I do think it's better to be open to all possible outcomes. And so with all that said, we will be looking to see this week if we can indeed set a third and final angle. If we don't, or if somehow we get a very hot print in CPI or the market reacts negatively towards CPI, then we will be having to entertain having some kind of top come in here and targeting much lower down. I did notice the Dow Jones is holding up the best. We had the NASDAQ off over 500 points, which stopped me out of my current long position, and also notice it deviated away heavily from this yellow fractal, which is from the GFC. So it doesn't mean that we couldn't be about to set it from here, okay? It also doesn't mean that we couldn't set something more like this as a third angle, something more like this. But for now, at least, I have no position on the NASDAQ. I will be looking to get a new position on out of CPI if the market can respond favorably and if that CPI print is indeed lower. Maybe something like this is coming. But objectively speaking, we did set 1-2 angles and we have now broken down, refused to break out and closed back below it. So this is inherently bearish for the NASDAQ. Like I was saying, the Dow Jones holding up a little bit better. Maybe it is about to set its third angle. That's to be determined. And similarly to the NASDAQ, the S&P has lost its second angle, okay? It recovered it and then lost it. Now, it could be that we're about to set that second angle slightly lower down from here. It could also be that we just set the third angle. We haven't figured it out yet, okay? Maybe something like this, as I was showing you with the melt-up chart. But wholly speaking, there is a lot of uncertainty out there at the moment. The Russell 2K is also setting up for a move higher, but at the moment is not looking like it's got a great deal of follow through. So again, if we can get a lower CPI print, if we can see this Russell move into expansion to the upside, targeting about 2,700 plus, then happy days, we have indeed got a blow off top. But if the breadth continues to refuse to widen out here, if we get to see something more like this, then again, I think that would speak to having more of a distributive top rather than a blow off top. And for now at least, we have a VIX trading above 22. So perhaps on Wednesday we could get a VIX crush, okay? If that CPI is cold, perhaps we could see a big blow off top, this move down into a cycle low, and then we can look to see if we can get a nice strong push and a bit of hedging on from down there. Conversely, if we're going to enter a more distributive top, if we're going to have some kind of meltdown or some kind of big CPI miss, then we might end up having to entertain a VIX explosion here in the not too distant future. So I'm going to be cautiously keeping my eye on this, looking for a VIX crush, but ready to hedge in case this breakout retest resumption on the blue line actually holds. Gold should have left behind a daily cycle low here and be looking for further upside. We got breakout retest resumption of the downward sloping red resistance line, so we will be looking for a nice strong push here out of gold over the coming week. And for Bitcoin, we just about got stopped out yesterday. Look how close this was if I zoom right in. So I am currently flat Bitcoin at the moment from a trading position, have no trading position, still have my spot. And again, if we can get a push out of CPI, then you might see me attempt one final long here from a trading perspective if CPI and markets can get a nice big strong push, if there really is is an attempt here to set that third and final blow off top angle. I know a lot of people will be very worn down by Bitcoin at this point, and a lot of people will be thinking of going short or walking away or whatever, but markets have this way of wearing everyone out before they reveal their true direction. So there's no buy setup here for me at the moment, but I'm going to be keeping my eye out, especially as we come into that CPI print on Wednesday. Overall, the yields continue to move lower, continue to be forward pricing the upcoming rate cuts, and the dollar still perhaps looking to be finding a cycle low in the not too distant future. Maybe there's one final push lower, which will allow the last leg in the stock market and Bitcoin and gold to unfold. If this starts to break out this downward slope in red, I think I will be declaring that we have indeed got new weekly cycles and perhaps even yearly cycle lows behind us, and be looking for a big risk off moment to unfold, synonymous with that deflation that I've been talking about. So overall, what a week it's been. It's been very choppy, it's been very tiresome. I've seen toxicity returning to the space, but ultimately it's just another day in the office, right? Sometimes volatility shows up, uncertainty shows up, but the good news is I think once we get through the CPI data, we'll at least know where we stand, okay? If inflation is cold and the markets respond favorably to that, then there should be a last chance for some highs. Whether it's a blow off top or just a marginally higher high, there should at least be some trade setups and some opportunity to get behind. And of course, the inverse is true, okay? We'll learn something either way. As ever, we'll continue to take it one day at a time. We'll continue to come back on the weekend and check in on this hypothesis. Other than that, if you're a level 3 member, look out for the members only video for you guys that is coming just after this one. For everyone else, I hope you have a fantastic weekend. And until next time, take care from me. All the best. Cheers. Bye.